All right. Well, happy Tuesday, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the last week in mortgage today, where we take you through the week that was in the mortgage industry. And each week, I am pleased to be joined by one of our lender members as my co-host. And this week, sitting in the co-pilot seat, the CEO of Loan People, Max Leaman. Max, good to see you, and thanks for joining me.
Yeah, great to see you. Thanks for having me.
Absolutely. And let's go ahead and get into it. We have to lead with the interest rate climate, not because interest rates are great, but we've actually had a rally in the mortgage bond market. Now, granted, it was a rally from the depths of whatever the hell happened last week, but it's still a rally nonetheless. We got to talk about it.
Yeah, it was great. I remember we were sitting in a roundtable at TMC last week, and bond pricing was down about 150 basis points, and everyone's losing their mind. And then we all start pricing out rates, and some people are 7 and 8, some people are 7.5. It was full on in the sevens. I think last week I saw on a rate sheet, one day I saw 6.25, and one day I saw 7 and 8. So there you go. And now we're getting some relief and starting to see back into the low sixes. So hopefully, fingers crossed, this stays up, but probably not. It'll probably go back the other way a little bit.
It's like the October weather in Cleveland. The 30s yesterday, we're going to be 70 tomorrow. All over the place. But the larger point being, I mean, like, can you imagine how good 4.5% is going to look to a prospective home buyer if we can find a way to get the markets there sometime in the next 3, 4, 5, 6 months?
Oh yeah, man, it's going to be. I mean, we're going back. We look at, we oddly enough, and I know other people are talking about it. We've seen a lot of EPOs this second half of the year for various reasons, and you go and look at, what did they do, and these guys are at 3%. Saw some at 3.25, under 3. And it's just like, wow, that feels like an eternity ago that we were there. So if we can get things down back into the mid 4s, I think that's going to be, obviously it would be great for us. I think it'll be great for the housing market as well.
Yeah, absolutely. So we talked about this so much underlying demand from people that want to buy homes that for a bunch of different reasons cannot right now. But yeah, the broader point being, I mean, it's, here's the one thing I hope. We talk all the time on the show about the sensationalistic headlines about the housing market this year, and no friend to our industry. When Joe and Sally Barrow are constantly reading headlines about, the biggest drop in home values in 80 years, yet home values are up 15%.
Right.
So I hope when mortgage rates start plummeting, we see all these news stories about biggest drop in mortgage rates in decades when we go from 7.8 to 4.5.
Yeah, no, I agree. I'll say the one time that we kind of saw headlines work in our favor was last week when everybody was saying mortgage rates broke 7%. They broke 7%. And a lot of my guys were like, well, at least there's something out there, because usually it's mortgage rates drop, they drop, but they didn't tell you about the last 3 weeks that they kept going up. And so that's the constant battle with the borrower.
Yeah, never a dull moment in the mortgage industry. And what set this all off last week was the aforementioned sell-off in the bond market that happened on the first day of TMC conference. Not something you drop when you're planning an event. The worst day for the bond market in 20 years. But yeah. It was all this madness in the UK, with the UK kind of releasing a new budget that had a lot less fixed income buying, and it threw an already nervous fixed income and bond market and all the people that invest in it really into panic zone. And now we've pretty much erased all that sell off, all that panic, and we're back to just where rates were about 10 days ago, which isn't great.
Not in the sevens.
Not in the sevens.
So yeah, I think, and we've all seen it all year, right? The volatility has just been brutal. Everybody's scared everywhere you turn. So uncertainty is our biggest enemy, and there's certainly a lot of that right now. And looking forward to the day where we can kind of put all this behind us and definitely have some more certainty back. When maybe bonds change 5, 10 basis points a day, 20 basis points is a big move. But but yeah, it's fear and uncertainty, man. It is running rampant right now.
And we get the unwind, and the UK central bank kind of unwinds some of their statements and positions on fixed income, and we get a positive inflation number this week. We see a big rally in mortgage bonds and fixed
Yeah.
income and mortgage rates, and then we got an employment report today that showed it was 1 million less job openings in America. The JOLTS report, you'll hear it's talked about a lot of times. 1 million less job openings in August versus July. Normally, this would be a bad thing for the US economy, but actually right now it's exactly what the Federal Reserve wants. And
Yeah.
really, if you believe they know what they're doing, is a byproduct of some of their efforts to that point. So it's been a really positive week in terms of just forward-looking data, and things that kind of speak to the future of where mortgage rates could be. So gotta appreciate those moments this year.
Yeah, definitely. They're few and far between. So, looking ahead, we'll see what future inflation numbers look like. That's I don't think you'll start to see real positive inflation numbers until what the October reading comes out in November. I think we'll probably be down slightly in September, but not enough to really move the needle. Still over 8, so what does that look like? But hopefully after that, now that those older years numbers have been replaced, we'll start to see that number come down, and hopefully that'll help drive rates back down.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by the CEO of Loan People, Max Leaman. And Loan People, such a great story of this company. Max, you started Loan People like right before the pandemic. You were a big time producer, started your own, took the leap, terrifying thing, started your own company, unbeknownst to you, just months before a global pandemic took over the world.
Yeah.
But I know just from speaking to Aaron and some of the other people at your company, like 2020, what a crazy year to get going in a year with that much volume. Fortunate in a lot of ways, crazy in a lot of ways, but just so happy to see where you guys sit now, 2.5 years later. Just really a great story, and kudos to you for having the guts to do it, because most people don't have the courage to make that leap to do what you did, and it's a really cool story.
Yeah, thank you, thank you. For those that don't know, I'll just tell you real quick. I was a top originator for 20 years. Top number 1 in Texas and top 10 in the nation, like the last 10, 11 years. And just kind of decided I was tired of saying if this was my company, I would do it this way. I said it one too many times and decided to take the leap, and called Aaron in 2019, and we started getting things going. And yeah, we opened the doors January 2020. March definitely got a little bit scary. Wasn't sure with forbearance and all of that if we were going to make it, but we did, and we thrived, and started growing out branches in 2021, and still growing this year. And fortunately, we banked a lot of money, so we're kind of able to weather these times. And the other good thing is we're super, super lean. That's kind of the idea behind it. So even in this environment, when a lot of companies are losing money, we're still in the black. So we've got a lot to be thankful for, and really just looking forward to the future growth, and adding loan officers and branches that want to be a part of this platform.
It's a great stuff. You got a CEO, a former top producer. You don't always see that. In my experience, has been a winning formula for mortgage lenders, and it's for a lot of the obvious reasons. It's the best of the best. It's putting a system in place company wide that kind of befits what made them great, and obviously typically good sales culture at those types of companies.
Yeah, it allowed our team to close. I was always a $300 million team, and then we did 577 in 2020, and Leaman team was able to do 695 last year in 2021. Loan People did 835 million. So it's, I really believe that we've put together a really good platform where people can grow, be efficient, and do more loans with less time. And then, I understand what the loan officers are dealing with. There's a lot of companies out there that really have a difficult time empathizing with what the loan officers are going through, and what it's like being on the street. And I'd like to say I'm head of sales. I'm directly involved with the loan officers. Questions, concerns. We do a weekly sales call. We call it study hall, and everybody kind of gets up there and we just kind of riff back and forth and see what's going on. So it's really, so far it's been a really great recipe, and I'm really thankful for everybody that supported us along the way.
Good stuff. Great story. And the company Loan People are headquartered in Austin, Texas, where you sit presently, one of the hottest housing markets in America. And just some of the run up to this show, just doing a little Googling around, and you're seeing what you would think you would see when you Google Austin housing market.
Yeah.
A lot of columns about how it is piping hot, and rents are going up, and the city's just expanding, outside the inner city limits. Take us inside the Austin, Texas housing market, because it's one that is really, I think, of great intrigue to our members, either that lend there or maybe don't lend there.
Yeah, what a wild ride, man. We went from everything was just kind of trucking along, and once COVID hits, rates drop and everything goes bananas. There's less than 2 weeks of inventory in the market. Everything's going 100,000 over ask, 200,000 over ask. No financing contingencies, sellers not paying title policy. I saw several deals where buyers were paying closing costs for the sellers. And it's been nuts for the last year and a half or so. Started to settle down a little bit this year. And as of recently, it's really kind of getting back to a more normal market, which is really interesting to kind of just watch the mentality of everybody in that market, right? I mean, you saw TCAD, Travis County Appraisal District, came out earlier this year and basically doubled almost everybody's value. I saw a property the other day that was 430 last year, and they upped it to 800 this year. Now they got a homestead cap, so they can't tax it the whole way. But that's the story. And some interesting stats, kind of for me, really started in May, when we really started to see things slow down. And as rates came up, you started seeing a lot more listings come to market really quickly because sellers wanted to get in before it was too late. You start then seeing more price decreases than new listings coming up, and pendings just keep going down. Fast forward to September. Well, really, if you go back, the average price in Austin was 592 in January, and it was 610 in February. We peaked in May, somewhere around 660, I believe. And then in September, it's down to 608. So, all those gains this year are close to gone, but still well above where we were in 2020, 2019. And now there's 4.5 months of supply, and that continues to grow. And it makes sense, right? I mean, when you look at from a buyer perspective, who's buying a house right now with rates in the 6s and 7s? It's not a move-up buyer. I just mentioned about the property tax situation that's going on. You go sell a house you own a house, you go sell it for 700, but you're only being taxed at 400. Now you got to go buy a new house that's 800, so you're doubling your tax basis. You've probably got a rate in the 3s, so you're doubling your interest rate. This is why you have a lot of people sitting on the sidelines. So it's really now more first-time home buyers, or people that have to buy, either they're moving here from out of state or out of city, or there's a divorce situation, something like that. But the good news about Austin is it's a strong economy. We're still adding jobs. Samsung is coming to town. Tesla's doing their thing. Apple's still building a big campus. There's lots and lots of jobs coming here. So it's good for the market. Obviously, we can't sustain 50 to 100% increase in value every year. So it's kind of nice to slow down, and people, like I said earlier, with the mentality, people just kind of getting back to, oh yeah, this is what it was like in 2019 and before, and I can have time to go pick up my kids from school, or maybe go to the dentist or something like that. So yeah, it's interesting, and that's kind of what I'm seeing so far.
Austin, such a cool town, blue city in a red state. The whole keep Austin weird thing. You got obviously the University of Texas, one of the biggest universities in America, smack dab in the middle of downtown. I wonder, is with all the growth that Austin's seeing, and now the aforementioned some of the corporate headquarter movements, which is Apple and Tesla and some other companies, bringing a lot of workers to Austin. Has it changed at all, like the social dynamic of Austin, and or is that something maybe that's you see happening in the future?
I think it depends on who you ask. There's definitely a lot more. I've been in Austin for over 20 years. So when I got here, there was 6th Street on downtown, and that was all there really was. And now, you have so many different places: East 6, West 6, East Austin, Domain. I mean, there's stuff
Rainy,
on, you
rainy,
know,
my favorite. I love
Rainy
rainy.
Street. Oh yeah, man, we go down there all the time. Shout out to Bangers if any of y'all come out here. Uh, Make sure to go there and tell them I sent you. But it's just all these different little pockets. South Congress. There's really, I love it. I think there's something to do for everybody. You can to get a different fix on what you're looking for. So it's growth is a good thing. There's a lot of people in town that say, don't Dallas my Austin, don't California my Austin, stay out. But I think growth is good. It's good for the housing market. It's good for us that are in the industry. I like that my kids are growing up here with so much to do. So yeah, I love it. I'm glad it's happening.
And you got Arch Manning coming to town.
Yes, we do. Yes, we
I've
do.
told you this before, but at the TMBA, Texas MBA this year, Peyton Manning was the keynote. Max was the guy that interviewed him. I did such a phenomenal job
Thank you.
interviewing Peyton Manning, and he was such an unbelievable interview. I've heard a lot of those things over the years. That was one of the best speeches, or it was actually like chat with you that I've heard. He was great.
He was great. It was I don't get starstruck. They asked me why I was doing it, and I said, well, honestly, I just want to promote young people. I mean, Peyton Manning, so who doesn't want to talk to him? But it's fine. I was given, he was really, really nice, definitely there for business. But we had a good conversation before. I was given rules. The 3 rules were: I was not allowed to talk about ask about religion. I was not allowed to ask about his kids specifically. We could talk about sports and things of that nature. And under no circumstance was I to bring up Arch. So
Well, I didn't realize the third brother. I don't know. I'm a huge
yeah,
sports fan, Peyton and Eli. I didn't realize the third brother, I don't know how I missed that, got hurt badly his senior year of college, but was a top pro prospect.
yeah.
And Arch, who, if anybody doesn't know, Arch Manning is the son of the third Manning brother and one of the top quarterback prospects in the country, and going to Texas next year.
Yeah, yeah. It's and I knew some of it, and I really put in a lot of research. I didn't want to mess that up. But yeah, apparently when he got hurt, that's when Peyton changed his number in honor of his brother. And the other thing that I found interesting, that was Eli was actually really, really devastated by that injury, and he had some mental stuff to overcome because of it, because big brother got hurt and he was the idol, and all of that. But the other thing is too, we all see Peyton on TV. I didn't realize, he's got this, it's called College Bowl, and it's like a college trivia deal, and they give away scholarships, and he does that with his brother Cooper, which I thought was pretty interesting.
Very cool. Yeah. Sorry for the diversion. Our
Yeah.
Angie Scarfino on our team is really insulted. I didn't know about the other brother. She's so in love with Peyton Manning. She had named one of her children after him. So Angie, a big Peyton Manning fan. Yeah, it was just a fun little aside. But Max, where I want to go next is just with your history as a top producer. There's a lot of talk, not only at TMC Chicago last week, but just in general in our industry, like the changing preferences of the consumer in our industry,
Yeah.
the American home buyer. It's a huge emphasis on technology in the mortgage industry the last 6-7 years, a lot of it on customer facing stuff. You could talk to different people what they feel like to this point their return on that investment in tech has yielded them, but clearly borrowers are changing. And who better to go to kind of get their take on this than you? Would just be interested on your perspective on the home buyer of today. I mean, especially in a really tough market like this, and just some of the characteristics, some of the changes you're seeing, as opposed to the past.
Yeah. So, forever and ever and ever, we've been very successful, being available to borrowers, approachable to borrowers, and not being pushy to borrowers. Somebody gets pre-qualified, let me know if you have any questions. If you see any houses, we can send you some estimates, that kind of thing. What we've started to really see, the majority of home buyers right now, like I mentioned before, are first-time home buyers, 26 to 33, 34. They were raised with cell phones and instant messaging and all of these things, and they want to be checked in on. They don't like the "I'll reach out if I need something" approach as much, which is perfectly fine. It's a different generation. So what I've discovered is, loan officers really need to be reaching out and checking in on borrowers. Hey, did you have any questions? I see you haven't filled out the loan application. What's going on? We don't have all your documents. Do you have any questions? Hey, you're pre-qualified. How's the search going? What's going on? How are your kids doing? How is your wife? They really want that personal, but they also don't particularly care for phone calls as much. It's more text messages, emails. For any of y'all that still are kind of old school like me and still use a landline, I highly recommend you make sure that landline is able to send and receive text messages. Automation is key, whether it's weekly emails that are going out, your Friday checkups of, hey, just remember my team's here. I'm here if you have any questions over the weekend, if you need to see estimates. But it's more hand holding, more checking in, less phone calls, and really more information than what we've seen in the past. So and more options. Everybody sits in front of a computer all day, and so you can hear customers on the phone Googling things while you're talking to them. So you better know what you're talking about, and you better have data to back it up, and you better give them all their options. So that's it's strange. It used to be you just hey, 30-year fix is going to be your best. Here's the rate. Here you go. And now it's not that way for the most part anymore.
So well said, because right, the lazy, easy stereotype is, oh, young people don't want to be bothered. They just want to do everything on their phone, and but really, I think the opposite is true. I think they want to be notified. They want to be able to ignore it if they can, text message, but they want constant barrages of information and updates. That jives with, again, talking to really gifted salespeople. You hear the same things, and I agree with that completely.
Yeah, I mean, it makes sense, right? Like, look at the world that we live in now with TikTok and Instagram and instant gratification and now and 30-second clips and short attention spans, if you will, for everybody. I mean, that's just, if you're not changing the way you're doing business to adapt with the times, you're going to go away.
Especially in this climate, right? Because if you are an aspiring home buyer, it's an anxious time right now. It really is. I mean, there's not a lot of options. The rates are not great. You really, the young person that doesn't know the housing market intimately really, really needs the expertise of somebody that does now more than ever.
Well, and I think in addition to that, if you look back as to what was going on the last 2 years, this particular set of buyer really didn't get much attention, right? Loan officers were so busy. No, I can't fill out the application with you in my office. You want to meet, fill out the application, we'll schedule a time to talk, right? Oh, but you want to go get a house under contract? Good luck with that. You're going to have to go offer, $100,000 or $200,000 over asking. You're probably not going to get it because you're competing with it, sometimes 15, 20 offers. So, from their perspective, I get it. You've been beating me up for the last year and a half, 2 years. And I need some love. I need more information, more love, like I said, and to try to get back in here.
Because right now, you have a market where there's not a lot of volume. We've certainly seen some consolidation and some M&A. over the course of the last year in the mortgage industry, but probably a few too many hands in the cookie jar, especially now, but even when things normalize a little. So incumbent upon lenders to differentiate themselves. And
Mhm.
with the financial markets in just so much, so volatile this year, as a loan originator, to be able to be a trusted advisor and to speak at least somewhat intelligently about what the hell's going on with rates. And hey, just because the Fed is supposed to be raising rates next Tuesday, it doesn't mean mortgage rates are going up next Tuesday by 75 basis points. And being able to explain that to people, even if you're repurposing the words of others that do it fabulously in all the email newsletters we get.
Yeah, absolutely. I agree. I mean, you've got to be the expert. And what is your value? What is your value to the customer? What is your value to your referral partner? I call back people quickly is not really a value. That's just your job. But what are you doing to educate the consumer? What are you doing to be the loan officer for life? And what are you doing to help your real estate partners get more business? That's again, that's how you're successful. And if you don't know what that is and you can't figure that out, you're not going to be long for this, because unfortunately in this environment we're seeing a lot of people not make it. And the cream of the crop, they're going to be fine, they're going to make it and move forward.
We know markets like this, the best loan originators, the best companies, they grow market share because they expect it, they're ready for it, they've got the types of companies and cultures that can sustain it and are sitting pretty when this thing turns. And those of us like you and I had been through this for a lot of years. We know that the turn is coming around the corner. And just like we did not expect the uphill climb to be so fast when it started in February, we could come down the hill pretty quickly as well if these numbers start to turn around and all the actions of the Fed these last several months do what they're intended to do. So little dash of optimism as we get into the fourth quarter of 2022 from Rich and Max today.
Well, the one thing I like to remind everybody is this too shall pass, and be ready. I made sure my team knew that when the good times would stop, it was going to be hard and fast. Now, I didn't know it was going to be like this. I don't think anybody did, but I do agree when it gets better, it's probably going to switch like that. So.
Good stuff, Max. Really, really enjoyed the conversation. Really appreciate you sharing your insight and expertise with our listeners and viewers. And we'll definitely have you back in the co-pilot seat for Last Week in Mortgage Today soon.
Well, I really appreciate you guys having me, and thank you for the opportunity. Really appreciate all you guys do.
And to our attendees, thank you so much for joining us. We're here every Tuesday from 2 to 2:30 Eastern with the Last Week in Mortgage Today, live on Zoom, on YouTube after, and then where most of you listen on podcast. If you're watching live or on YouTube, go to search TMC Connect on Spotify or Apple, wherever you get your podcasts, to digest the show that way as well. And until next Tuesday, have a great rest of the week, everyone. Thanks again, Max.
Thank you, guys.
Take care.